Welcome back, everyone. Stephen Morris here with Advisory, and today we're going to dive a little further into estate taxation, specifically around the topic of what happens to real estate as it is highly appreciated, and what are some tax planning strategies to avoid a certain trap. Today I have Afshin Asher here with Asher Law Group, and he's going to give us a little bit of a primer on what to do in terms of estate taxation planning on your highly appreciated real estate assets. So let's dive into this here. Here's the typical play, and especially here in Los Angeles, we've seen a huge surge in valuations, let's call it over the past 30 to 40 years, and maybe your mom or dad bought a piece of property in the 1980s, a rental property perhaps, a duplex or a triplex. It's been generating some very good rental income. They bought it for $300,000. And today, the broker comes up to you and says, do you know I could sell your property for $3 million? Does that interest you at all? Of course, that sounds like a great outcome to me. What are some considerations around this highly appreciated asset as it relates to when your parents are transferring it to you, either through life or through the estate taxation?
It's amazing how often I have prospective clients reach out to me and say that I want to avoid the estate tax, so I'm going to transfer my property to my kids while I'm alive, and then we don't have to worry about it.
That seems easy, right?
Easy enough.
Yeah.
You sign the deed and you've transferred it over.
Big loophole around the death tax, right?
And I'm not even going to get into property taxes at this juncture.
Yeah.
The estate tax is only applicable to individuals with estates over $15 million.
Okay.
Or couples with some basic planning and a tax return filed. A couple can transfer $30 million without estate taxes. So a fair number of people are not subject to estate taxes.
Yeah.
So that shouldn't be their motivation for making a transfer.
And we should pause here. If that is a big problem for you, you've done pretty well in life, just to be very clear here. That's called a quality problem to consider, right?
Absolutely. In the LA area especially, a good portion of our clients have estates over $30 million. But let's just focus in on the typical person, like myself, who doesn't have an estate over $30 million. In my opinion, bar none, the biggest loophole in the tax law is what we commonly refer to as the step-up in basis.
Yeah.
And essentially that means that the government is going to forgive all the taxes on the appreciation of your assets when you pass away. I reiterate, when you pass away.
Yeah.
And so when you transfer something while you're alive and it's no longer your asset when you pass away, you forgo that loophole. And so essentially, I don't have to explain it to you. What that means is that if you buy a property for $300,000 and it's worth $3 million, and your children inherit that property, it's as if they bought it for $3 million, not $300,000 like you did. In contrast, if you give it to them while you're alive, then from that point forward, whatever your cost basis is, will be their cost basis. If it was $300,000, it'll be $300,000 for them. In the context of rental real estate, it'll even be worse than that because you take depreciation deductions every year to lower your income tax from the rental income. And so your cost basis actually drops below $300,000 over time. And you may have a very low cost basis, and then you transfer it to your children, and they're straddled with that same low cost basis. By keeping it and letting them inheriting it after you die, you completely avoid that. Your children get a new step up in basis. They can sell it for $3 million, or if they want to, if they're keeping their property, they can start depreciation deductions all over again.
At the $3 million.
At the $3 million, which is much more advantageous to them.
So let's be clear here. If there's one thing to take away from all this, if you were under that lifetime exclusion, that lifetime exemption of the $15 million per person or $30 million jointly, you would never give away such highly appreciated assets like the situation we're talking about here. Let's say you own the $300,000 asset. It's worth $3 million today. You have $5 million or $6 million in assets, well under the exclusion. We would never give this away during life. We would wait till death, and then it would pass down to the kids through the estate method, and you would see the step up in basis move up to that amount. Just to be very clear, that's a TLDR in case you didn't want to watch all this video. This is the most important takeaway point that you got to have here.
And you certainly shouldn't use it as an alternative to writing a trust because you just think it's easier to just transfer it to your children while you're alive and not have to do estate planning.
Yeah, absolutely. Okay, so that covers what happens if you're under that lifetime exclusion. But what happens if you're over it? Your parents are over $30 million, you're over $30 million with your spouse. What then? What's the consideration?
Well, the estate tax on the amount over the about $15 or $30 million exclusion is 40%. It's fairly hefty. And a lot of the strategies we employ to reduce that estate tax, unfortunately, is contradictory to what we just discussed about getting the step up in basis.
Yeah.
So what we oftentimes do to reduce the estate taxes, unfortunately, involves transferring assets, as we just told you not to do for families with smaller estates, and transferring your cost basis to your children. But I wanted to bring up one relatively simple strategy that high net worth clients can consider that could reduce estate taxes without too much complexity. The concept is a valuation concept.
Yep.
If you own a property that's worth $1 million and you pass away, when we value it for the IRS, we have to say the property was worth $1 million. On the other hand, if you own a property that's worth $2 million, let's say, but you have a 50% interest in that property, you have a partner, and so your 50% at that point is not worth $1 million, even though the whole property is worth $2 million.
Sure.
Under valuation principles and really common sense, nobody wants to be partners with someone else if they can avoid it.
Yeah.
If you try to list your 50% interest in a property, you'll be hard pressed to find a buyer who's going to be.
Your market's going to be this small.
Yeah. And so the idea is that the appraiser are going to say, yes, the property is worth $2 million, but your 50% is worth less than $1 million.
Sure.
And so they take valuation discounts, is what we refer to them, for lack of control, lack of marketability, and so reduce it by about 30%, 35%. I've seen 37%. And so that by in and of itself can reduce your potential estate tax liability. So our first step when we have families with high net worth over the $30 million threshold is to make sure that they don't have 100% interest in anything.
Yep.
We set up LLCs, we transfer at least small percentages of these LLCs to their children while they're alive, so that when they die, they don't have 100% interest, and we can reduce the values that way.
Yep, that makes perfect sense to me. And again, it just makes logical sense. If you're trying to buy 1/3 of a property, it's not going to be worth 1/3 of the whole property because the marketability is lower. You got to get into bed with other owners, theoretically. It's just not the right way to own real estate. This type of valuation method is probably one of the best ones. It doesn't help us on the income tax side, though. I got to warn you about that. So you're still going to get this much smaller, much lower cost basis than even this discounted for market value would be in most circumstances.
Right. Unfortunately, the more we're able to reduce the value of your estate for estate tax purposes, we also get the equivalent lower step up in basis.
Yeah, so to be clear, when we're starting to move into this realm of getting past the lifetime exclusion, getting around to being subject to estate tax, we have to work together hand in hand to make sure all aspects are considered. We're talking about income tax planning and estate tax planning. We can work in tandem to kind of achieve the right result. Sometimes we have to pick and choose. We can't have our cake and eat it too.
Well, what I enjoy working with you, one of the many reasons I enjoy working with you is that when properties are held in partnerships or LLCs, we have to adjust the basis when a person dies.
Yep.
And there are two types of basis, your shares in the LLC as well as the underlying real estate. And to get that adjustment, you have to make what is called the 754 election.
Yep.
And a fair number of accountants I've dealt with didn't even know what a 754 election is. And so you're on top of it, and we make sure that we get whatever advantages we can when a person passes away.
Yeah, and to be clear, if we're talking about this step up in basis, it's basically that step up now gets this special allocation in partnerships is what we're talking about here, where then whoever's the heir of this particular share, this particular piece of property is now going to have an increased basis. They can convey their portion of the property with less of an income tax consequence, and more importantly, it unlocks more depreciation deductions as well.
Yeah, and
step up basis.
All the time we get clients who lost someone. Years have passed and their accountant didn't talk to them about the 754 election. And unfortunately, it's too late.
It's way too late. You got to do it the year it happens. If another tax year crosses, it's over. You got to wait till many, many years later when the property is ultimately disposed of, and it's a really bad tax outcome overall.
Yeah.
So we've seen that a lot. We've seen a lot of tax returns where 754 elections were not taken, and we have to inform our clients, sorry, they can't even go back and amend. It is what it is. So I hope you guys found this really helpful, especially as it relates to what happens to your property when you're going to pass it on to your heirs. What happens when real estate that becomes highly appreciated has certain tax consequences around it, not just income tax consequences. We're also talking about estate taxation. We learned overall that if you're under the exclusion, you never want to gift it, never, okay? However, if we're over the exclusion, then we start to bring in interesting concepts like valuation techniques, other sorts of considerations like that, which will greatly help your tax consequences out on the estate side. We do have to work together on this, and so if you start to have issues like this that you want to consider, whether you're under or over, if you just want to explore this topic more, then feel free to reach out to us right here, and we'll be more than happy to assist you as it relates to planning around your highly appreciated real estate. Thank you so much for watching.